if they were to ever pursue this avenue of raising capital, well, technically debt, what sort of questions might they expect from a housing bond underwriter to ask of them in their project?
In some market, you might project rent growth at 3%. And in some markets, that's great. Going into an inflationary economy where we kind of are today, nobody knows what's going to happen. The increase in the rent is not unsubstantiated, but can you actually get it in some of these markets? And so that bond underwriter is going to look at how aggressive you're trying to grow rent. They're going to look at how aggressive you're running your occupancy. Are you projecting a 98% occupancy across the board? Even though that's what the market is bearing in that market where you're building it or putting it or buying it, doesn't necessarily mean that that's the best way to put this on a pro forma. So you may need to dial that back a little bit. You're also going to look for bad debt equations because just because all of your units are filled doesn't mean everybody has paid their rent this month. And so you've got a bad debt number. And where are you projecting that to be? And maybe the ability to pay that resident have in that market, you may need to allocate a little bit more for that. In that pro forma, they're looking at how do you have your management staff? Is there a management fee that you're going to pay a third-party management company? Is you got 1% of that rent collected, or do you have 5% projected? Just depending on your market, how are you projecting your make-ready costs, your turnover costs? Everything is looked at. And if you've got a property that's new built, you don't have to maybe spend $3,000 a unit turn. But if you've got a 50-year-old asset in some neighborhoods, you may be lucky to spend $3,000 when somebody moves out. It may cost you more.
Yeah, and I love that you brought up two things. When I was on a call with you and the bond underwriters, they said things like, hey, if you go above 3 or 5% rent growth, sometimes that might be viewed as ultra aggressive to some purchasers or investors in these bonds. And if they see that your rent growth assumption is 5%, they might stop looking at your project altogether because they're like, oh, they're trying to be super aggressive with this one rent assumption. Where else are they being aggressive within the pro forma? They also asked about the track record and the reputation of our contractors. And I think that was a very valid question because they want to see like, hey, is the GC that you're using have undertaken such a large project? Like if it's 452 units, right? Have they done a project that big? And if not, where else are you guys pulling in people with mentor experience to oversee the project and actually making sure that you're mitigating the execution risk? What are you actually doing from your team composition standpoint to actually take care of the project and deliver on the plan that you're looking for?
That was a valuable piece. And I think even down to just like the property management, you know, you've got a great operator of operating the property, but if you've got a sizable construction budget there, then not only has this guy done this before, because he might have, but can we look at it on his website? Does he have references that we can check? Is he bondable? So can he get a payment and performance bond to make sure that he pays his sub? Can he get a payment and performance bond to ensure all the investors' money is going to be safe? And so that's what all of these different measures are put in place for, is just to ensure that the likelihood of this project coming to fruition and being completed as underwritten.
Welcome to another episode of Affordable Housing and Real Estate Investing. Today, guys, I'm so excited because I got two of my best friends in the world today on this podcast. And we're going to be talking about something that's really exciting. We're going to be talking about bonds today. And I can't wait because when I first learned about this topic, I was a little mind blown. It's one of those topics that you learn in college, but you don't really pay attention to it unless you're like, this really applies to me now. And when it comes to affordable housing, I thought, hey, why should I ask all these questions on my own? Why not have fun and bring on somebody from the community? So today, I have Jen Aintablian coming on to the podcast today. Jen, how are you doing today? What's going on with you?
I am doing great. I am so excited to be part of this. I am a true fan. I listen to so many of the affordable housing podcasts. It has just meant so much to me and in my journey. So to be able to be a part of this and learn from the experts, what a cool experience.
Well, I'm excited to have you on. So before we get to Alvin, because Alvin's the OG and he's been on the podcast a few times already, tell us a little bit about who you are, Jen, and what's your background and what's your history with real estate?
Well, I am new into the affordable housing real estate space. I am a humanitarian by trade. So I have lived abroad whenever there have been man-made or human-made wars. I'm normally one of the first people on the scenes, mobilizing teams and making things happen. So I love to think outside the box. I love to raise money for things that I believe in. And so when I moved back to America, I had some friends who were in the real estate space and just saw the opportunity to help my own community. So that's when I dove in and made a lot of mistakes. I'm definitely new on the journey. I have one Burr property right now that I am just pushing towards the finish line, and I am learning among both of you. And so I'm super thrilled to be part of this, but definitely on the new space. So I'm going to be asking all those questions from the beginning when it comes to bonds.
I love that. And Mr. Alvin Hope Johnson, how are you doing today?
Yeah, I'm doing fine. Jen, good to see you again. I'm doing great, Kat. Happy Monday.
Yeah, I know. We're on Memorial Day. We're recording this on Memorial Day. And I think this should speak volumes to the amount of dedication that this group has to providing value. A lot of folks might be out hanging out, doing a little barbecue, but we said, hey, let's take this day off. Let's put some value out to the world. And best of all, the topic for this podcast really came from Jen, because she said, hey, I really want to learn more about bonds. Can we do something together? And I said, yeah, why don't we have you come on and you ask some questions? Because I'm sure the questions that you have, Jen, are questions that are applicable to so many people out there. So Jen, why don't I let you kick it off? Why don't you go through some of the questions that you had and let's just take it from there.
Well, great. Well, I'm going to kind of start with the big overarching. I am fresh into this, new. What are bonds? Can you just explain it within the real estate context and kind of how you go about getting bonds for projects?
Well, Jen, a bond is a debt security like an IOU. So borrowers issue bonds to raise money from investors willing to lend them money for a certain amount of time. So a bond is a security instrument. It's much like a mortgage, where it is used as a secondary or primary source of security for real estate. So much like buying your home today, you'll go to Chase Bank, whatever bank, and they do a mortgage for you. You don't ever see the money come from the bank to the seller. You see it at the title company on paper, but the only thing you do is you sign your life away on about 300 pages of documents that say you have a mortgage. The security for that mortgage is the home. With the bond, that is another form of security for that mortgage. So the bonds can be sold to secondary markets. They can be sold on an open market. They can be bought by individuals. They can be bought by high net worth individuals. Corporations buy them as an additional security. That's their security or way of investing their money at whatever that coupon rate is for that bond. And that's how the developer, owner, seller, whatever gets the money. So they get a mortgage as a security instrument, but also that sometimes if you're using bonds for this, that bond is wrapped into that mortgage.
Yeah, just like in mortgages where you can have a construction loan, you can have a regular loan. Are there different types of bonds as well that you would use for this? Or is bond just kind of a simple IOU?
Okay, first of all, we're going to say that none of this is investment advice for anybody. We're just having a great conversation between friends. None of us are the true experts. We're talking about some things from our limited experience. Okay, so now let's put this back in context. And so it's really just a high-level IOU, but it gives the investor a coupon rate. It's also marketable. So as in a true mortgage, that mortgage is marketable to somebody else that buys mortgages. But if you're just a simple investor in these bonds and they give you a stack of bonds worth $500,000 because that's your investment, then you could market that stack of bonds without it affecting the mortgage itself. The property owner would never know that you sold your investment in those bonds. So it's additional security for the mortgage that is a marketable document or security instrument.
So you can layer this tool with other tools as well. So this is, okay.
Now, let's talk about some of those tools. Most lenders want to be in first lien position. Now, with these bonds, and we are talking taxable and tax exempt. For the sake of that term bonds, that can be either one of those, okay? But if you're looking at a tax-exempt bond that's exclusive for charity work, houses, hospitals, jails, the city issues municipal bonds, all of those kind of bonds are tax-exempt for their intended purpose. Those bonds are whatever that coupon rate is, so that investor has an opportunity to not pay on any taxes on the gains that they make. So over the life of that bond, if that bond is a 5-year, 10-year, 30-year bond, just think about a mortgage. If you buy a $200,000 house at an 8-9% interest rate for 30 years, you pay back, $500,000-$600,000. That markup in interest is taxable to that mortgage holder because they made that as profit. Well, if that were a tax-exempt bond, then there are no taxes made on those earnings because that money was used exclusively for the betterment of that charity, nonprofit, city, government, whatever, to make a better place. And so you don't pay taxes on that money. It's really a great tool for that the IRS, the government, whoever made those rules, as a way to spur development into those areas, because you may not typically buy a municipal bond or an affordable housing bond at a 5% rate when you can go put it somewhere else. So what's the lure to help you want to do that? Oh, well, we don't pay any taxes on the gain. Yeah, we can park a lot of money there. I mean, like a lot of money there and don't pay any taxes on it. And it's secured by first liens on the property. And there are instances where you're doing just say you're doing let's use 50 million, because you typically won't do one for less than 30 because the cost of issuance and attorneys and et cetera just does not allow that cost to work. But if you're doing a $50 million deal, your cost of issuance and some of your other costs may be taxable. So you'll have a first layer or first tranche of bonds that's tax exempt, then you'll have a taxable tail to pay for some of the costs that are not allowable under the tax exempt piece. But the investor knows that they're buying, there's an A tranche of bonds and a B tranche of bonds. And in a situation where you're doing a new development or a development where the developer has to put in equity, there's a situation or an opportunity where you can take 10% of that cost because you have to put in 10% equity, right? So you got to put in $5 million of this $50 million deal as equity. They can issue bonds for that piece as well, so that I can sell that to an investor and that investor can invest with us on a tax exempt basis. That's another way. But in that situation, you're part of this total bond allocation, but there is a piece at 40 million. There may be a B piece at 2.5 to 3 million or whatever those numbers need to be. And then your third piece is the 5 million that you put in. But you're paid at the same time the A's and the B's are paid. So every 6 months, you'll get a coupon. It works out for long-term investors that want to park money in deals that have a great feasibility study and a great market study that show that, this thing is a feasible project today and will be for a long time. And let's talk about some of the issuers. The issuers can be housing authorities, city governments. If you're talking specifically housing bonds, there are several organizations across the country that they'll just issue you bonds. A bond is like a blank check with a bank name on it, but there's no money in the account until somebody buys the bond. So they're absolutely worthless until you put together an opportunity, profile a great deal, all shovel-ready project or an existing project that makes sense and underwrites. And you go to a placement agent, an underwriter. There's several firms that we've talked to lately. G.A. Davison is one that we're using now. They do several $100 million a year. They're really big in this space. They said they're number 4 or 5 in the country every year. They do all kind of bonds. You'll go to a deal like that. They underwrite it. So the bonds have been issued by, say, ABC Housing Authority. They issued you $40 million worth of bonds to do your project because that's what your total cost is. So you'll go to this underwriter and say, hey, we got bonds this year. And it's a process to do that. There are a lot of attorney fees to get there, but it's worth it in the end. And then Jen Aintablian will take it and they're underwrite because they're going to be the ones that take your bonds to market. And so they put together the performers. You've already gotten your market studies and appraisals and et cetera of what this project is going to be, how it's going to pencil out over the next minimum 15 years. And that's typically what the market studies will show. And then they put their stamp of approval on it by doing their in-house underwriting as bond underwriters. And then all the attorneys bless it. And then it goes to market. And sometimes they do private placement where they know people that want the bonds, so they can do that. And then I could come straight to Kent and say, Ken, I know you want to place $5 million. Here's a great deal that's underwritten by this group and it's signed, and you can do your underwriting process and maybe you'll buy the bonds. Or if it's not a private placement, they can just take it to market in their firms. We all know them, Amazon, everybody, big ones.
Got it. And Alvin, to kind of set the stage for the audience, right? All the different parties that are involved in the bond transaction. I've heard the issuer. I've heard the placement agent. I've heard the housing authority. I've heard of the nonprofit developers, right? Just help us outline sort of what are the roles first that's involved in the transaction. Like, let's start with the issuers. Like, who are these issuers? Why do they have the right to issue these bonds?
I'm going to try to answer it the best way I can. Let's use the housing authority, for instance. Why would they have the authority to do that? It's a congressional approval that they have to be able to do that. And I would keep it simple to say that the tool that they can use to spur the development of their mission, which is to provide safe, decent, sanitary, affordable housing to the people that need it in any demographic area. So to keep it simple, I would say that's why they have the approval to do it.
Got it. So you have someone with the approval to issue these bonds. How does a placement agent and a nonprofit come into place? Do you need a nonprofit to issue these bonds because you need to have a nonprofit with that 501c3 status?
Well, if you're talking tax-exempt bonds, there has to be a nonprofit vehicle that will be the owner of the asset. But you don't have to have a nonprofit to do investment grade bonds. You can walk into a couple of groups that we know of that do this, and we're kind of going through a process with them right now. So I'll give it as I understand it. What they would do is they'll underwrite our project. So they have underwritten our project. And from their underwriting, they think that these things pencil out for a great investment grade bond opportunity. I think they told us 90% of stabilized value is what they will lend up to on a new build project. So what that means, 90% of stabilized value is probably 100% of cost to get it built. The reason they can do that is because they're underwriting this as an investment grade bond, and they're using today a 5% coupon rate for those bonds. So they have, I guess, anybody that has FINRA or whatever credentials that are needed in the investment banking world to issue these bonds, probably a Securities 6 and 7 license or something. They put together an offering for $50 million. And what they do is they underwrite it with so much debt, so much equity, same way we do it here with an investment grade or with a syndicated deal. And they have this underwritten and feasibility study done by one of the large 4 accounting firms in the country, just say maybe a KPMG or somebody like that. Those guys have the ability and the data to look at this, underwrite it today, forecast out 15 years or 5 years or however long those bonds are, and substantiate that stabilized value that they're going to lend off of is going to be exactly what we say it is in 5 years or 10 years. And so with that surety, then they're actually able to insure those bonds and issue them as an investment grade. So you don't need a nonprofit for that. You just need a great promoter, a great project, and a great group of guys that know what they're doing to be able to pull that off.
Okay, so it sounds a little complex to the newbie, but with the right team, I can see how it can produce really great benefits. So just kind of stepping back a little bit more philosophical, how do housing directly contribute to affordable housing initiatives? Like, why pursue bonds? How does it make it worth it within the affordable housing space?
That's a great question. Sometimes I've had to ask myself that, why am I going through the trouble of this? But sometimes it could be for the leverage, where typically you would get a 75% leverage on a purchase and acquisition. And using the bonding process, they may go up to 90% LTV, which if you do your numbers could be 100% of your purchase, acquisition, and rehab costs or construction costs. So you have a higher leverage, which is not always the best, because that means you have to operate at such high levels of occupancy. You have to operate to make it work, right? So there has to be a balance there, but you get higher leverage. Sometimes the interest rates, the coupon rates are less than traditional mortgages, maybe up to a point. So when you're looking at a 30-year mortgage on $30, $40, $50 million situation, that can be a lot of money. And if it's truly an affordable deal and the mission is to provide this level of housing, the set aside that you put in place for the benefit of the resident stays there through the duration of those bonds being in place. And sometimes a lot longer than that, just depending on how they were structured in the beginning. So that may mean 50% of the units may be set aside for people that make 80% of the area median income from the day you open and for the next 30 or 40 years. Sometimes they have extended use periods like that. So it ensures that this product continues out for what it was intended when it was financed this way. Some assurance has been in place that way.
No, Alvin, I like how you explained that, because I think for people, I mean, sometimes we go out to the market and we talk to people that have issues raising capital, because what has happened over the last couple of years with housing and a slowdown we've seen because of high interest rates, we've seen people struggle to raise capital. And when you struggle to raise equity, what's the other side of the equation? Well, there's debt. And bonds is just another debt instrument out there that's available for you to finance the construction of your projects. Now, it's interestingly enough that you talk about how these can be used. And obviously, once you sell the bonds, right, the proceeds from those bonds are used to build the affordable housing or purchase or acquire. So you pay interest on the amount you draw. But who would want to buy these bonds, I guess, is the question. Who invests in bonds? Because we hear about Apple stock. We hear about Tesla all the time, but not a lot of people talk about bonds. So help us understand a little bit, why would people want to invest in these bonds? You talked about the tax-exempt piece a little bit, but just from your general understanding, why do people invest in bonds?
Some people believe bonds are safer than the stock market. Some do. I mean, if you're buying a municipal bond, it's kind of insured to some degree by that city staying in business. So you would think that very few cities go bankrupt, but it has happened. So their ratings on those bankrupt cities goes down, meaning that that's a little riskier investment. But you would think the same is true with housing bonds. You would think, hey, this is an apartment complex. I feel good about, I know where my money is going. So when I invest in this, I feel good about making an investment into helping somebody's life become better. And so if I'm going to invest in something that's going to pay me a 6% coupon rate, why not do it into housing? And I get a benefit for maybe not paying any taxes on the gains. It makes it a win-win situation. It could be, I guess, hit with the right platform, depending on the amount of bonds that were being sold or that you wanted to invest in. It could be a small mom and pop to some degree, because I guess there are probably opportunities for people to pull their money together and buy a large chunk of these kind of bonds. I'm sure that there are some platforms out there that probably do that as well. So it can be anybody, or it could be Amazon, your large organizations like that, because they're looking for ways to sometimes park money and invest it and not pay taxes on everything. So there's some benefits there for them as well.
Yeah. The only thing I would add there is, like, we've heard of other, let's say, life insurance companies. They might take in annuities. They pay 3% on their annuities, but then they get to arbitrage that capital into higher interest yielding investments like bonds, but not with as much risk as equities. We heard of regional banks or smaller banks, because of the CRA, the Community Reinvestment Act, that they have to buy low-income housing tax credits, or they have to buy housing bonds because that's their investment that meets their own agenda or quota or whatever mandate that they have to reinvest back in the community. And affordable housing qualifies as one of those. So those are all different items that we've seen in the marketplace and why people invest in these bonds, besides for just the tax-exempt status, but it's also their reinvestment and how they qualify for it. Jen, how was that for you?
Yeah, I think that's super fascinating. And we just had an investor meeting recently, and it was interesting because in this investor meeting, they were actually more concerned about the risks than the possible returns. And so on that, what type of risks are associated in investing in bonds? And you mentioned cities are probably not going to go bankrupt, but it is an election year. Are there like politics and policies that impact, increase or decrease the risk? Like, what does risk look like with bonds?
Great question. I'll say it is an investment. So first of all, if anybody's willing to invest somebody, don't do it for some amount that you can't afford to use. That's realistic. It's an investment. I don't care if you're buying stock or whatever. The best part of this, Jen, is it's backed by real estate that is tangible, that you can see, that you can go touch, and that if it's operated correctly and this thing is underwritten well, which is why we go to a great organization that underwrites the bonds that takes them to market. They've got a pretty good reputation of doing this and providing great product to the market, then you could probably say it's a fairly safe investment because it's, again, backed by this tangible piece of real estate and it had a pretty good underwriter. Now, there are market conditions that change that affect every type of investment. Insurance has gone up 300, 400% in the last 3-4 years. And if you turn on the news today, you will see there are hurricanes all across the Midwest, people dying, houses flipped over. And so we wonder why our insurance costs are going up. I didn't have any claim, but how do the company take care of my claim when they're paying those out if they don't increase everybody's rates? We have no control over that. And our rents don't go up 300, 400, 500% a year, as though some of those other expenses do. But overall, Jen, I would say it's a fairly safe investment if the underwriter is a great one with a great market reputation of bringing great stuff to market, then I would say that it's a fairly good investment.
Yeah. Having the right of people around you in any situation just makes the whole process easier and smoother, which is why I'm grateful for you too. So now, what are some of the returns when it comes to investing in housing bonds? And kind of separating, you mentioned the tax exempt and the investment grade, like if you have an example of what that could look like.
Great question. And I think this kind of goes back to how safe or secure are these investments. Because these are fairly safe and sound, underwritten well investments, some of the tax-exempt bonds, today's coupon is somewhere close to 6.5%. So that's the actual return to the investor. Depending on your tax bracket, and your gains that you're going to make on that based on the time you stay in that investment, that 6.5 could equate to significant amount more overall interest because you're not having to net out taxes. So it helps that way. The rate that we were quoted or that was talked about with the investment grade bond was about 5%. And I think that was last week that he quoted us that rate. And I would assume the same thing there because an insured type bond, A-rated situation, they consider relatively a good investment. So the rates are not 9, 10, 12, 15% like you would see, in a hard money type loan or even an equity share position where you may be paying equity investors 9 to 12% IRR on their money, where this situation alleviates the need for that because they finance higher leverage on the front end, which allows you enough room on the back end to refi it out because your value is where it is. So
that's a great lead in, Alvin, because we were just going to talk about how long do these housing bonds typically take to be recapitalized or repaid in full, because we just talked a lot about the relatively safe nature of these investment grade bonds because they're backed by real estate. How long do you typically expect either tax-exempt or investment grade bonds to take before you actually pay them back off? Because everybody might like the returns on interest rate, but at some point they're going to want their entire principal back.
Good question, Ken. It really depends on the project and how they structure it in the beginning. Like a lot of the bonds that we're doing on the tax-exempt side, they have an AP, so a little small taxable. That's typically bought by the same buyer, and we have a 35-year amortization on that, and sometimes they'll go out to 40. So, Jen, that's another advantage of some of these, maybe even having a 40-year amortization with a lower rate that they make more money, but it also helps the project float a little better. They have a 40-year mortgage in there, and they probably will have a lockout period from 1 to 10 years, with the interest prepayment being 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, based on the year you pay it off, because they are expecting a certain yield on their money. If you're looking at the investment grade bonds, they quoted us 5 years. So they are structuring that issuance to be a 5-year, giving you an opportunity to get it built, get it stabilized, increase your value, and then refi it in 5 years. And that refinance will allow you to pay out all of your bondholders. So it really just depends on the deal. It could be, I probably wouldn't see one for less than 3 or 4 years. We had to negotiate really hard to get us a 3-year option on one that we're refinancing now. And because the bondholders are putting out a substantial amount of money and they want a specified yield on their money for that amount of, they know what their metrics are. And so we had to really negotiate to try to get that down to something that allowed us to get out after 3 years if we chose to. But if the market is not conducive for that and we don't think it's great, the rate could be a lot higher to go refinance, or cap rates can be not compressed as much and be prohibitive, then we're locked in for 35 years.
So return is influenced by interest rates. We've definitely seen that the last few years. And so you talk about negotiating lower rates. How do you go about doing that? And how does credit rating affect the housing bond interest rate?
Well, I'm sorry, we didn't have an opportunity to negotiate the rate, but we did have an opportunity to negotiate a prepay where they had a expected, I guess we could do the math, 6.5% for 30 years, and they had a 10-year prepayment penalty on it. And so in year one, that 10% of that is what they expect their yields to be, I guess, at a minimum. And so knowing that's what they need, then how do you try to meet what somebody else needs and get what you desire? It's really just kind of meeting in the middle. And that probably has to do with a story, because it's not a situation that we're trying to do this to monopolize or capitalize on the market. This was a situation where we're doing this in order to get this project done, which you guys really fully support, because that's your mission. We appreciate that. But it's also done in a way that because you're doing this with us, and this thing's really worth about $25 million more than what we're bringing it to market at, is giving us an opportunity in 3 or 4 years to pay you off, give you a fair return on your investment, and maybe allow another nonprofit organization to step in and own this and carry out their mission and pay down some additional debt. So there are several reasons that story could impact the person that has to make that decision. And just being open and honest and transparent on why we want it. Not saying we'll exercise it, but it'd be great that if the market is right and we can, let us go.
I love that. And now that we understand a credit rating, we talked about A-graded bonds earlier. Obviously, that's one of your higher level tranche of bonds or grades for bonds that tends to indicate the relatively secure and safety of that investment. It all originates from how a housing bond underwriter even looks at the project, right, Alvin? So in your experience, right, what kind of questions has a housing bond underwriter asked you about the projects? Because what we really want people to walk away from this podcast is if they were to ever pursue this avenue of raising capital, well, technically debt, for these projects, what sort of questions might they expect from a housing bond underwriter to ask of them in their project?
Great question. And I'll say this and then lead into your question. Is it difficult to do a situation or a deal like this with a new entity that has no balance sheet? Yes, it's extremely difficult to do that. It's kind of like an 18-year-old just getting his first credit card, and instead of it being a $250 Capital One, he applies for $1 million American Express. You're probably just not going to get that your first round out of the bat. And because you have no assets to back it, no experience behind it. And so there will sometimes need to be a stand-in-the-gap person or organization to support that. Someone with a balance sheet, someone that believes in the mission, or another organization that has the capacity to do that. And that organization will need to have a balance sheet just to show that it has the wherewithal to be able to support this in the event something went wrong. Now, when you talk about the project specifically, in some market, you may project rent growth at 3%. We're going to project rent growth next year, 3. And in some markets, that's great. Going into an inflationary economy where we kind of are today, and everything's kind of uncertain. As Jen said, this is an election year. Is the low inflation number really falsely low? Or is it going to stay here until after the election? Nobody knows what's going to happen. So projecting a substantial rent growth, even though property owners need it because of the increased insurance costs, increased taxes across the board, refrigerators, carpet, everything that we buy has increased 10 to 15%. The increase in the rent is not unsubstantiated, but can you actually get it in some of these markets? And so that bond underwriter is going to look at how aggressive you're trying to grow rent. They're going to look at how aggressive you're running your occupancy. Are you projecting a 98% occupancy across the board? Well, even though that's what the market is bearing in that market where you're building it or putting it or buying it, doesn't necessarily mean that that's the best way to put this on a pro forma. So you may need to dial that back a little bit. You're also going to look for bad debt equations, because just because all of your units are filled doesn't mean everybody has paid their rent this month. And so you got a bad debt number. And where are you projecting that to be? Is you got 1% of that rent collected, or do you have 5% projected, just depending on your market and the jobs in that market and maybe the ability to pay that residents have in that market? You may need to allocate a little bit more for that. In that pro forma kit, they're looking at how do you have your management staffed? So is there a management fee that you're going to pay a third-party management company? Because there needs to be, and one with an experience in running this type of property. So that gives another level of insurance, Jim, to the investors that, hey, not only has this deal been underwritten well, but now we've got an experienced owner, operator, and property manager to support this. So that makes everybody feel a little bit better with their investment as well. And let's see, everything down to, do you have to buy light bulb? How are you projecting your make-ready costs, your turnover costs? Everything is looked at, and their industry standards for vintage age properties. Now, if you've got a property that's new built, you don't have to maybe spend $3,000 a unit on a unit turn. But if you've got a 50-year-old asset in some neighborhoods, you may be lucky to spend $3,000 when somebody moves out. It may cost you more. So it really, all of that is kind of property and market specific, but there are certain principal guidelines that the underwriters look at.
Yeah, and I love that you brought up two things. Maybe 2 points I'll emphasize is when I was on a call with you and the bond underwriters, they said things like, hey, if you go above 3 or 5% rent growth, sometimes that might be viewed as ultra aggressive to some purchasers or investors in these bonds. And if they see that your rent growth assumption is 5%, they might stop looking at your project altogether because they're like, oh, they're trying to be super aggressive with this one rent assumption. Where else are they being aggressive within the pro forma? So I think that was a great lesson that we took away from that conversation. It's because everybody has different lens in which they look at the project. And some people might be really aggressive on the top line, but then you have to understand when people are looking at it for the first time and they're viewing this as a safer investment, what are you putting into the performance that might make it look less safe and look less secure, especially if you're going for 98% occupancy right away? It's not just unicorns and rainbows. You might not be able to get 98% occupancy your first year. So we got to be a little bit realistic on it. And the second piece I'll highlight is, Alvin, they also asked about the track record and the reputation of our contractors. And I think that was a very valid question because they want to see like, hey, is the GC that you're using, have they undertaken such a large project? Like if it's 452 units, right? Have they done a project that big? And if not, where else are you guys pulling in people with commensurate experience to oversee the project and actually making sure that you're mitigating the execution risk? This might look great on paper, but what are you actually doing from your team composition standpoint to actually take care of the project and deliver on the plan that you're looking for?
Correct. That was a valuable piece. And I think even down to just like the property management, you've got a great operator of operating the property, but if you've got a sizable construction budget there, then not only has this guy done this before, because he might have, but can we look at it on his website? Does he have references that we can check? Is he bondable? So can he get a payment and performance bond to make sure that he pays his sub? Can he get a payment and performance bond to ensure all the investors that their money is going to be safe? And so that's what all of these different measures are put in place for, is just to ensure that the likelihood of this project coming to fruition and being completed as underwritten. So just making sure all those things work.
So just making sure that I understand that last piece. So there's required government accountability mechanisms. Is that what it is that you're referring to? Like construction monitoring and reporting that are specific to bonds, or is this something separate?
Something separate, but that construction monitoring and et cetera is going to be required by the bond issuers or the bond holder. So the bond holders require, before any money is drawn for construction, that there's a third party that inspects the work, makes sure that it's applicable, the billing is correct, and that money is paid out at that time. And according to a pre-approved draw schedule, there's compliance in place to ensure that happens. And then even down to what you say you're going to spend per unit. I mean, it's literally tracked down to that much of a penny. And secondarily, if this is a tax-exempt bond thing where you have a certain number of units set aside for a particular income bracket, there are compliance measures put in place by the issuer as well for their bondholders to make sure that their tax-exempt allocation that they have on their investment is not lost. Because if you've invested in this deal as a tax-exempt deal and expecting that kind of return and benefits from doing that, but the guy over here operating it doesn't know that everybody here has to qualify and be in this particular income bracket, and there's no compliance measures there, then that blows up that whole tax-exempt status deal, and everybody's pretty upset from that position. And so, there are a lot of compliance measures in place for that.
Yeah.
And that's another analysis that you need to do on the front end. Are you going to want to be able to continue to do this for the life of these bonds? And of course, there's a cost associated with that. There are audits required at the end of the year for tax purposes and for accounting purposes. So can you make sure that this thing operates in a way to be able to take care of those additional expenses? And are you up for the task? As a first-time owner, maybe not. But that's when you can partner with somebody. And I can tell you, just saying, I'll hire a third-party management company does not answer all the questions, because those are people too. And all they do is hire an individual from the area, and they try to put in great systems to allow those people from that area to operate under their umbrella. And sometimes it works, but sometimes those people that sit on the property and work there are only employees, and they're only going to do what they're going to do. And so I said that to say that sometimes, even as a property owner, there needs to be an asset manager in place to make sure that the property management company is being checked. So who's checking the checker, right? So the asset manager will do that to keep them in line and make sure that they're hitting budget numbers and across the board, because that's just another level of accountability as the owner that you have to provide. And you got to figure out how to pay for that. And so sometimes it can come from the proceeds of these developments, and sometimes it can't. And so that's just great ownership. And again, that's responsibility. So anytime we talk about these bonds and these mortgages and, it's just a piece of paper, but it really is somebody's money behind all of this. And so there's a great level of responsibility that should be even thought about before you think about borrowing somebody else's money, even if it is a mortgage.
Yeah. And you've talked a lot about building good teams around all of these projects. From just this conversation, it sounds like finding a good underwriter is like finding gold. So this is kind of a newbie question, but do you have a underwriter and a team based off of your project and what tools you use? So like if you choose to use bonds, you go this direction with this underwriter, or do you have like people who are kind of consistent throughout all of your projects?
That's a great question. We've had a lot of consistency in the legal department. So we've got a great legal team. We've been with them about 6 years, and they don't guide, but they really do provide a lot of guidance for me. We've got a legal team that's headed by one attorney under a large firm umbrella, and he has a team of 4 attorneys that work under him, and he is in the affordable housing business. He operates a nonprofit for veterans. And so everything that I'm talking about when we're doing these deals, he knows more than I do. And I don't have to educate him on what we're trying to accomplish. Most of the conversations with him, he's giving me suggestions and saying, Alvin, I think we should do this. And I'm like, I love it because I trust in one. He's never given me bad guidance. And I know he knows this business. Now, I'm not saying that everything that everybody does is for benefit of them, because sometimes it is for the benefit of the cause. But sometimes there are opportunities where he makes presentations where it's for his organization, but that organization is better in the cause. And so it's still symbiotic, right? And so I appreciate having him. We have this new underwriter that we found. Well, Chris, my attorney, has worked with him for years. This guy's been in the business over 40 years. He's with a firm that's been around 100 years. So that all of those are great things. But down to the relationship of me being able to trust my attorney and know that he runs this type of business, and for him to recommend somebody to me, I didn't need to know anymore. And I see the track records. And then you meet him, and the first thing you want to do is meet on site. That's kind of unusual for somebody that's not going to be serious about their business. And so with him being an underwriter, basically all he is a glorified loan originator. He has to find business. So that was great. And so I know that we can have a lot of consistency with him over the next several years. And then we're always, I think, as everybody's always evolving and growing and the markets change and people's investment appetites change, there's always an opportunity to meet new investors. Investors meaning lenders, partners, bond issuers, all of these people that play a role in each one of these steps. So just continuing to network and continuing to just do good and make great relationships will continue to help any of us grow.
Man, I'm going to wrap it up here. But Alvin, I think I can speak firsthand. It's just been so incredible being on this journey with both of you and being able to be part of the conversations and listening to the questions that people ask of us. It's been invaluable. So Alvin, thank you so much for your mentorship. I always appreciate you being so open and giving with the information to go deep into a topic that might be boring for some folks, but I love this stuff and I love learning about this stuff. So truly for that, I'm grateful. Jen, anything else to add from you? I want to make sure people are able to follow you and get your Instagram information too.
Yeah, definitely. I mean, thank you so much. My brain does hurt a little bit for a holiday weekend, but it was just so packed full of great information. And I think mostly I am just excited to hear about all the opportunities there are to really bring together people for a cause that is affordable housing that's so needed and can truly make an impact in the communities which we all individually live. And bonds is part of that. And so I think, yeah, that was so exciting. And I'm excited to learn more as we continue. So my Instagram, if you want to follow a newbie who's new on the journey and sharing what I am learning along the way, I have an Instagram, humanitarian.investor. And yeah, so come follow along.
I love it. And Alvin, where can people find out more about you and get in touch with you?
Alvin Hope Johnson, Instagram, Facebook, LinkedIn, and those are probably the three best. You know, we are in a different, depending on who you ask, right? There's always different cycles of life. And I think that there's a lot of uncertainty in the market right now. Kent and I spoke to an individual that runs a pretty successful firm. He's been around 30 years and he went through the 2008 situation and made some great positions and sales on assets before it was too late and made a lot of money on the comeback. And some of the things that they have predicted for this year and next year, because they see things that all the economists see, some of the things have never happened before, and some of it is mirroring what they saw in 2006 and 2007. that, things have changed in the last couple of years as far as capital with higher interest rates, making it sometimes harder to borrow money and harder to get projects done and leverages and things. So the one thing that I want to say to the person, newbie, OB, whatever we are, the only way we will lose is if we quit. That's the only way we will not get done what we want to get done. We will have some missteps. And I won't call them mistakes because if we made them in good energy and in good faith, then they were made only on the information that we had in hand. So it can't be a mistake. But we may have a misstep or two along the way. But if we don't quit, we will surely accomplish what we want. And that's one of the things that Kent and I have seen over the last 2 years. And that's kind of what some of the stuff I've seen over the last 35 years of my career. And so that's it.
Well, thanks, Alvin. And that's why we're building this community together. We're building a community full of affordable housing and real estate investors. And the whole point is so we can give ourselves higher chances of attracting the right people that are not quitters, first and foremost. But when you can surround yourself with the right folks with the right heart and the right level of commitment, I think that's going to be the magic that a lot of people are looking for in this world. So with that, if you guys are interested in affordable housing, just DM me the word affordable on Instagram. You can find me at Invest with Kent He on Instagram. DM me the word affordable. We'll send you the invite, get you in our community, and then you guys can ask as many questions as you want, just like Jen did with myself and Alvin, because this is our mission. We're just trying to give away all this information for free because we think truly the information is the first step on how we create more affordable housing and truly solve this problem in the world. So thank you, everybody. I appreciate you all, and we'll be back soon next week.